Today, I'm chatting with Peter Grandich. In this interview, we discuss what's happening in the junior markets, where Peter sees resource stocks heading, and the psychology of trying to get through a bear market. All right, everybody, enjoy the interview. Peter, thanks so much for coming back on.
Good to be with you, Steve, again.
So I'm happy to have you on here because it's been a bit of a rough time for a lot of us sort of small cap junior investors. I got some data in front of me here that shows that if we look at the broad indexes, the stock market's had a pretty great year. But then when you actually break down the S&P 500, 7 stocks have effectively made up all the gains in the S&P 500. Now, I know that you often do invest in juniors. When the markets are kind of like this and they're kind of dry, how do you sort of maintain your psychology or your positive outlook on life when it is a bit of a struggle in your investing world, or maybe you're doing just fine? I'm just assuming that you're having a hard time like a lot of us are.
Well, first of all, I start by not showing my wife my portfolio. And then I realized that you don't say the word gains and junior resource stocks in the same sentence, at least this year. Uh, it. I've told people that if you and I were having this conversation 3 or 6 months ago, I would say the very same thing back then what I'm going to say to you now. I've never seen in almost 40 years in this juniors be so unloved, unwelcomed, and yet so spread between the actually underlying metals that they're looking to find has never been greater. Markets, even when gold was $300, what juniors were selling for then had a better valuation than what they're giving now with gold at 1900 and change. So in some aspects, I'm happy to be empty or alone or near alone in the boat. But I think the turn, which I would have suspected would have happened by now if we were speaking 3 or 6 months ago, uh, seems to be shaping out what I like to call an L. We've gone about as low as we can. I mean, realistically, the only further they can go is they turn the lights off and we're left in the dark. I mean, it's an amazing, and this is across the board, Steve. It's not just in gold stocks. It's almost any types, even the lithiums that come way back. Maybe the exception would be uranium because they have managed to not get caught up in this junior resource growling bear market at a time when metals are still very nicely priced. So what I would tell you is it's a difficult period. I have noticed a lot of the commentators suffering from select amnesia or sliding away from commenting on it, hoping people kind of not ask them about it. But it's been very difficult to withstand. But I am personally confident, and what my needs and risks that I can take are different than others. But I know because of what world demand is being placed on metals and the lack of real exploration and development for maybe almost 20 years, not just 10, of a serious nature is going to lead to a huge deficit. And we're going to wake up one day and we just got to hope we live long enough and survive it long enough to see these things have one of their, great bull runs like we've seen in the past.
I was chatting with one junior mining CEO the other day who's been around. He's been through a couple cycles, and he made a comment that some people look at what happened in 2020 and 2021 as that was a resource bull market, but he kind of felt like that was actually more of a blip. And we actually haven't really seen a good resource or junior resource investing market since like 2011. What's your kind of view on it? Do you think that we've just kind of been in this rut for like a decade, or do you think that you've just sort of got to take the cycles that you can get and be happy with it?
So, Steve, I wrote a report not too long ago called Junior Resource Stocks, Goodbye or Goodbye, because even at that point in time, which was a few weeks ago, they became so compelling, so disjointed from metals prices. But I also wised up and try to look at the market from when I was really involved in it 10, 20, 30 years ago. And there are a few big changes I think are worth noting. The first is there's just not the automatic get involved people that the junior resource company stock had at one time. And that's the thousands, if not tens of thousands of financial advisors in Canada and the US that built a book of business around, commission driven individual stocks. And a lot of them did it with resource. So if a junior resource company, whether at a conference or in their direct marketing, got he or she involved, they got hundreds of their clients involved. Well, those people are dinosaurs. There may be a few left, but you can probably count them on your hands how many are left. And yet, even if those same investors are out there, and I call that into question, I think things like cryptocurrencies and cannabis and other things took a lot of those people away from the market. But even if they still existed, the junior resource company now has to find another direct or indirect way to those people. And it's much more challenging. And what complicated it is regulatory. Here in the US, Steve, even if there was a financial advisor still doing that, he or she probably can't, because if it's not trading on the NASDAQ, the listed NASDAQ, or the New York Stock Exchange, the brokerage firms just don't let them buy it, even on an unsolicited basis, including discount brokers. So even if there is a retail investor handling it on their own, they have trouble at certain discount brokerages just because they have an OT symbol doesn't mean that they allow them to buy the stock. That, I think, is two key things. I also think another thing that isn't spoken about, the industry was always fragmented. It wasn't a very large market. The same 10 or 12 speakers, if we spoke here or in Europe or Asia, it was always almost the same guys and gals. And some passed away, some just got gray hair or no hair like me, and new ones have come on. But it's never seen an increased interest. I would argue it's probably seen a decrease from 10 or 15 years ago. And so it's made it very much challenging for resource companies to find good shareholder interest. The same dozen or so institutions exist, the same few funds that exist. And it always is a mistake by investors to think, hey, if the stock market can only go bad, if bonds could drop, if the economy could be bad, people are going to call up for certain and want to buy a junior resource stock. No, that isn't what happens. And we had until recently a pretty bad market for a couple of years, which wasn't going to favor junior resource stocks, even though some of the metal prices were going higher. So I think it's a very changed playing field than 10 or 20 years ago. I think it's more challenging, but it doesn't take away from the fact that this comes at a time when, if you're going to believe the bulls of the world and the things that people predicting where the world's going with electrification and renewable energy and all these things, there's such a deficit coming of needed and above ground ready supply on a variety of metals that one day it just will turn, and then people will realize that, and suddenly, it'll just have a flash, and it'll be back to a roaring bull market. But there is one thing I know you agree with. It seems like in the junior resource market, there are much more bear markets than bull markets, and they seem to last longer, and they're far more painful on the downside than the enjoyment that you have on the upside. And anybody that's been in this and doesn't say that has been living in a world I don't know of.
It's hard. We had one company we invested in that we found out recently went into bankruptcy, and it was just sort of caught us by surprise. We didn't see it coming, and it's just sort of how bad can it get, and just the overall just lack of liquidity that exists. I was talking with one investor earlier this week, and he said to me, my portfolio 2 years ago was $30 million. Now it's down to $6 million. And I know that if I went to liquidate those positions, there's no way I'm getting $6 million for them. And so it's just sort of now the advice that he gave me about these types of markets is the way you maintain positive psychology when it is tough is you got to look at your best positions that you're most optimistic about and really lean into those. And that's kind of where you sort of get your hope when the times get really tough.
Well, you bring up a very good point. It's always been a market that had a lot of lack of liquidity. It was never even its best
Yeah.
days, just a place where you can just blow off a half a million, a million shares of a stock and not move the price. But what's really added to the downside here now is there is a throwing in the towel in the last several weeks. You can tell people are selling, a stock could have great news and go up on a half a million shares, 10 cents. And the next day on 50,000 shares, not only lose that 10 cents, but be down another 10 cents. And that is two things: the illiquidity and just selling has beget selling now. That's where it's at. So anybody that's in a position to buy is going, whoa, I might as well wait another day because so far it's paid the wait. And that is the mentality right now. I know a few people very well seasoned in this, far better at it than even I, and even they are seeing losses that are incomprehensible to them, given what they know the company's actually doing. And it is the worst. It's hard to say this because it's the worst bear market ever in 40 years. Yet the metals are way up. Normally they're coming crashing down while you're having that bad market, and that's not the case now.
It's funny you say that because I've heard that from a few investors that this is the worst bear market they can ever remember. And it's just I've wondered if that's a case of recency bias because it is very painful right now for people who have taken on a tremendous amount of risk since say 2021. If it's recency bias that we're saying that, but I mean you've been in this game for a pretty long time. Would you agree with that sentiment that this does feel like the worst bear market you've seen for juniors?
It is. It is. Especially when you compare it to what the metal prices that they would be receiving if they're successful in what they do. Listen, I can remember multiple years standing at PDAC because there was always a tendency, it was called the PDAC factor. Somehow the metals would get crushed just before the PDAC show would start. But I can remember thinking that if we can just get above three and a quarter, this will be great. And so it's hard to comprehend still, even though it's years later and you take into account inflation, that we're at 1900 and change. And we only feel that if it can just get through 2100, things will get better. And that's how severe I think of a bear market is. And the negativity in that, and this is important, I think it's important for people to understand is a lot of those people that are suffering, I'm one of them, I think you might be, and some others you spoke about, some of them are strictly just going to sell when that turn comes because they're just going to be glad to be relieved of the anguish. And that's what plays a role. And I always tell people in junior resource stocks this, and a lot don't listen. One, it's a business where failure is the norm, but you have to be prepared to lose part of all your capital, and most aren't. And so mental anguish causes them to take action prematurely to eject themselves out of sometimes only to then see it turn around. But there's also the people that say, I'm not going to sell because if I know if I sell today, it's going to go straight up tomorrow. That's not a good reason to stay in. The best reason to ask yourself now, Steve, in all seriousness, for you, for me, for anybody who's in this, forget where you've been, forget what's happened. Given what you know about the company you're investing and your outlook for metals or whatever it might be, could you still buy it today, even though you don't have the money to, maybe? And if the answer is yes, then you have to be at least a strong holder. If the answer is no, given everything I know now, then you got to eject yourself from it and move on. And that is a time to consider moving into the few that you have very high confidence in. But people don't do that. They sell their few winners to average down on the losers so they can somehow feel a bit better than just take what they can out of their losers and put it into one or two of their winners. But more times than not, that's the proved thing. I can tell you one thing I wish that happened overnight, Steve, in the junior market. There's a few hundred companies that are running on fumes. I mean, they're low price, they're way out market cap. They don't really have anything exciting going. Some of them are what I used to call retirement plans for these, guys that
Yep.
ran the company every few years, do enough work, raise enough money, recycle, reverse, start over. But if a few hundred companies disappeared, that's why not only do I believe there's going to be M&A for good reasons, I believe there's going to be consolidation just for survivability. It's really running low now. You can see so many companies with it's a picker's market of $10 million market caps. And they have advanced expiration. I'm not talking about just some package. I mean, it's advanced. So one of the people that's got to be licking their chops are the majors. There's no question. But that's why a few even paid 90% on takeovers, because even paying 90% versus 40% over the trailing trading price is still very low. So I think we're going to see a marked increase in that as the days and weeks here as we get into the summer and fall.
Here's a chart that I want to show you. I don't know if you can see it on the screen, but this is Marin Katuza tweeted this out. And you can see there that if we look at the volume on the TSX venture, you could see that it looks like it to be about like half of what it was from, forget about the COVID bubble that happened between 2020 and 2021. If we just look at those sort of means or medians, whatever you want to use, between 2013 to 2019, it looks like it's about half the volume that it was during that period.
Yeah, that's just another indication. And it is, we touched on it before, and I think this is important. It has received competition, most driven by cryptocurrency, even though a lot of those cryptocurrencies blew up, which is actually bad news because you can't even kind of switch back because that money's gone to money heaven. But what I've noticed is, and I wasn't at the conferences, so I don't know for certain, but I can tell by what I read, and I can tell by when I do say something negative about cryptocurrency, positive gold, the type of people that kind of write back all use the same line. Ah, you're an old man, you don't know this, or you're an old fogey, or whatever the case may be. And what I think the junior market always lost because it never spent a good time marketing the good principles of it is it's lost a lot of the younger investors that would have stepped in. I suspect if I went to a conference again, and I know they've come back, I suspect there would be a lot of gray hair and bald hairs, not a bunch of young youth running around as if you went to a cryptocurrency conference right now. And that's a negative. That is people that otherwise would have been involved. And so all these are challenging, and but it's why it's so depressed. But the good news is, especially for those that could step in now, the good news is it's not going to take a lot to double or triple from here. But doubling the triple for some may only bring it back to where they originally purchased it at.
Yeah. So if you were in a position where, let's just say that you had a little bit of cash on the sidelines and you were trying to find those names where, you can get comfortable with the risk reward. Are you looking for names where there's a lot of historic drilling and the company's trading at a fraction of the total drill value, or are there specific sort of resources that you're looking for, say nickel or copper or gold? What is it that you would be looking for right now if you were sitting on the sidelines with a bunch of cash?
Well, since I've gotten all the cash I could find out of my sofa and I put that to work, I'm not in that position, but I wish I was. But I can tell you a couple of things that I think are very important now. I think where the company is paramount. It's far more important now than it was 10, 20, or 30 years ago. I like to say this, and I'll just say it again for the umpteenth time. You could have spun a globe 20 or 30 years ago, blindly put your finger on a country and say, okay, we can go there. Can't do that now. There's too many negatives happening in certain areas of the world where I think mining companies is just going to say it's just too much risk. It's not worth going there. So I pretty much restricted my own investments to North America. Doesn't mean on a very special situation, I may look at Mexico or something like that. But I think where you look, and even if I said North America, I'm still not going to go and put a dollar's worth of money in the People's Republic of California, known as the state of California to others, because I think that's a very difficult place to try to mine. But I do think there's wonderful areas. Quebec is a wonderful, I think, one of the best jurisdictions to be to mining in, the Nevadas, the Arizonas. The base metals, you can almost throw a dot. They all have reasons because of all the needs. I obviously fancy copper over some of the other base metals. Tradition silver has seen a lot more fundamental needs for it. Uh, but I think, you can pretty well, the only thing I would just say is sometimes momentum players profit. And the one thing that has momentum now and looks like it wants to continue going higher is uranium and things related to uranium. But that's a very small market. It's very hard to find true producers in that. You can count on your hands the ones you can play. That's why I've always stuck with Cameco and felt how Cameco goes, so goes the uranium market. And that's why, I think it keeps making new highs. But if you want to start looking for depression, you can find that in almost any other market. Maybe the lithiums, although they're way down from their highs, they're not at rock bottom prices. But there are a lot of gold and silver, even copper plays now that are off 70, 80% and trading at valuations that just don't match what they have going for them.
You mentioned lithium, and I think that this is sort of a nice segue for what can knock us out of this sort of bear market. And I see what happened with lithium in Australia, right? Where they in Australia they had some lithium names start spitting out cash flow, and the Australian resource investors just fell in love with the commodity. They in Canada now, it's like how can companies create lithium projects that the Australians are going to like. That's something I commonly hear from various banker types, and that's sort of my view on what really can take us out of this is if we can get to a point where we see a couple of copper companies go from hitting some huge drill results or actually getting to production, and suddenly you've got these returns on certain equities where retail investors look at them and they go, hey, look at that. If I would have bought that at 50 cents, I could have had, a 50 bagger. And even talking about cannabis, for example, which brought in tremendous retail interest in Canada. I mean, we saw Facebook groups that had 20,000 active retail investors talking about stocks. It's something like I've never seen before, but that's because there were certain names like Canopy and Aurora that just, they ripped, and not only did they rip, right? We do see some resource stocks that rip, but then it's actually just a select group of people who own them the entire way up, and they never really built up a large retail following, so it didn't really attract enough attention to really get more retail investors in. But I feel like that's kind of what we need to see some stories actually really build out in terms of either building their asset or spitting out cash flow, or just a stock that develops a tremendous retail following that ultimately ends up being a 50 or 100 bagger, and then that's when people go, I can make a lot of money in resources, I ought to be there.
Well, it's all about perception too, Steve. You talked about Australia. The Australia junior resource market's doing quite well.
Yeah.
Now, why is it doing quite well for them? They're still seeing the same discrepancies and everything that we discussed, but they see the cup as half full. Not only do we not see it half full here, we see it basically completely empty. I've had to joke this, and I think because you would enjoy it, because you take resources very serious like I do. Somebody asked me, when will the bottom be? I says, as soon as I read some junior resource company left mining to go into AI. Then then I know the junior market for metals has reached the bottom. But you brought up a very good point at the start of this. Even the general stock market, where a lot of people right now are going, the worst is over. And there were a lot of bears talking about 50% decline more. Harry Dent's, the stock market's going to be down to 2,000, whatever the case is. They've been very wrong. But it's only been a handful of companies that made it look that way. And I can tell you this, even though the stock market is completely different than it was 30 or 40 years ago, it's just a high priced, technology driven casino now, where half the money is in passive funds. The other half is being driven by computers for all different algorithms and news stories. It's not the market where we used to buy to be part owners of businesses. But if it doesn't increase the breadth, if you don't see more companies participating, increases in new highs, volume more on the upside than downside, then this is what I think it is, a very strong bear market rally. And if you want to call it a mini bull or whatever they want to call it, in a much bigger secular bear market that I personally think At best, the stock market will go into a trading range for the next few years because there's just too many economic, social, and political negative factors to suspect that it can do anything like it did the last 10 or 20 years. And there's a lot of people, Steve, I don't know about in Canada, but there's a lot of US citizens who got accustomed to the returns that the markets were given and built a lifestyle around that and can ill afford not to continue getting that same type of return. And those are the people that I think are in trouble here because we're going to go from double digit returns to at best single digit returns. And 7 out of 10 people, I work still with a planning group here. We got clients in 47 different states. A lot of them are small businesses. And a lot of people are still living a lifestyle at least one level higher than what their true income brings in. And they don't like my motto in our planning group, which is less is more. They go right down to the guy down the street with the black box that says, hey, I got the way to get everything you need. And they don't want to hear about, cutting back or reducing exposure and things like that nature, even after what happened a year ago. But I think if they get hit like that again, they're not going to be able to withstand it. And that's where the guys and gals that have been predicting this dire market may finally get their day in the sun, but it isn't anywhere near in my view anyway.
All right. Well, Peter, thanks so much for hopping on here and chatting today. It's always a pleasure when I get to speak with you. For our audience that want to hear more of your commentary, where's the best place that they can go to?
Well, Twitter is where I spend much of my time now, but I also have a website, petergrandich.com, and on YouTube. And Steve, you have the best pre-interview conversations I have with anybody. And someday we should talk about it on air because now I got to watch this quarterback now up in Toronto when the CFL is playing.
It's something else for our audience. I was telling Peter about the Argos' new quarterback, Chad Kelly, who's a bit of a hot mess, but is truly, in my view, an NFL first round talent that nobody wanted to touch because of his personal life problems, but is just, he's a blast to watch and probably the most exciting player I've seen in the CFL, maybe since Doug Flutie. So if anybody in our audience loves football but doesn't really like giving the CFL a chance, I'd highly encourage them to check out the Argos right now, because we typically don't get fun players like this to watch, and we actually have one right now.
Well, it's good because Toronto needs to root for something because your hockey team, what happened, Steve? We'll save that for the next interview.
All right. Well, Peter, thanks so much for hopping on here. I really appreciate you hopping on here, and I wish you the best of luck as we wait for this bear market to turn around.
From your mouth to God's ears, Steve. God bless.
All right, everybody. Thank you for watching. If you could do me a big favor, please hit that like button, subscribe, and ring that notification bell. All right, guys. Let me know what you think in the comment section.